We're witnessing something extraordinary unfold in real time, and most people are interpreting it exactly backward. Microsoft just reported quarterly earnings that would have been considered spectacular in any other era. Revenue climbed to over $88 billion. Net income surged nearly 60% year over year to $24.1 billion. By traditional metrics, this is a triumph, yet the stock collapsed 7% in after-hours trading, erasing roughly $150 billion in market capitalization within hours. The message from investors was unmistakable. This isn't good enough. More precisely, the path Microsoft is on isn't sustainable at the scale and speed the market now demands. This reaction isn't irrational panic. It's the early recognition of a structural problem that will define the next phase of this economic cycle, and it's happening across the entire technology sector in ways that echo some of the most destructive wealth events in modern financial history. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. Let me walk you through what's actually happening here because the surface explanation misses the deeper systemic forces at work. Microsoft is spending approximately $75 to $80 billion on artificial intelligence infrastructure this year alone. That figure represents data centers, specialized chips from NVIDIA and other suppliers, cooling systems, energy infrastructure, and an entire logistics chain designed to support what the company believes will be the foundation of computing for the next decade. The company's capital expenditure has exploded from roughly $28 billion in fiscal 2023 to an estimated $80 billion in fiscal 2025. This is not incremental investment. This is a wholesale transformation of the company's cost structure and business model, executed at a velocity that has no historical parallel for a company of this scale. The problem investors are now confronting is straightforward but devastating. Where is the return? Microsoft's Azure cloud platform, which houses much of this AI investment, grew revenue by 31% year over year. That sounds robust until you realize the company is spending multiples of that growth rate to build capacity. The incremental revenue from AI-specific products like Copilot and Azure AI services is growing, but the absolute dollar contribution remains a fraction of the capital deployed. Industry estimates suggest Microsoft's AI revenue run rate is somewhere in the range of $10 to $15 billion annually. Against a $75 billion capital outlay, the math doesn't close. Not this year, not next year, maybe not for several years. What we're seeing is a massive bet on future monetization that requires sustained exponential growth in customer adoption, pricing power, and margin expansion, all while competitors make identical investments and flood the market with capacity. This is where history becomes uncomfortably relevant. The pattern we're watching has occurred multiple times across different industries and different technological eras, and each time the wealth destruction was catastrophic because the system itself was designed to amplify risk rather than absorb it. Consider the railroad boom of the 1860s and 70s. Capital poured into rail construction at an unprecedented rate. Investors believed they were funding the infrastructure of the future, which they were, but they ignored a critical detail: overcapacity. By the 1890s, the United States had built far more railroad track than demand warranted. Companies had taken on enormous debt to finance construction, assuming revenue growth would cover obligations. When it didn't, the defaults cascaded. The panic of 1893 wiped out banks, destroyed thousands of businesses, and triggered a depression that lasted years. The railroads were eventually valuable. The investors who funded them were annihilated. Move forward to the late 1990s and the telecom and fiber optic bubble. Companies like Global Crossing, WorldCom, and hundreds of smaller firms raised tens of billions in debt and equity to lay fiber optic cable across continents and oceans. The logic was identical to today: build the infrastructure and demand will follow. The internet was real. Bandwidth demand was real, but the pace of capacity installation far exceeded the pace of revenue growth. By 2001, the industry was drowning in dark fiber, unused capacity that had cost fortunes to deploy. WorldCom collapsed in the largest bankruptcy in U.S. history at that time. Global Crossing followed. Trillions of dollars in market value evaporated. The infrastructure eventually became useful, but the companies and investors who built it were destroyed in the process. Now consider the parallels to what is happening today across the AI infrastructure build-out. Microsoft is not alone. Alphabet is spending similar amounts. Amazon's AWS division is scaling capacity aggressively. Meta has committed tens of billions. Even smaller cloud providers and AI-focused startups are raising capital and deploying it into chips, data centers, and energy. The scale of this simultaneous investment is staggering. NVIDIA alone is projecting to ship well over $100 billion worth of AI accelerators in the next 12 months. Every one of those chips is being purchased by someone who believes they can generate returns exceeding the cost. But here's the structural problem. They're all building capacity for the same use cases, targeting the same customer base, in a market where pricing power is already eroding. Recent data from cloud pricing indices shows that the cost of AI inference, the actual computational work of running AI models, has dropped dramatically over the past 18 months. What cost $10 in early 2023 costs $2 today. Competition is forcing prices down while capital costs remain fixed or rising. Energy costs, particularly for data centers in constrained grids, are increasing. The cost of capital, meaning interest rates and equity financing costs, remains elevated compared to the zero-rate environment that fueled the last decade of tech expansion. Companies are being squeezed from both sides, falling revenue per unit and rising input costs. This is the exact configuration that precedes sector-wide distress. What makes this moment particularly dangerous is the embedded leverage. Microsoft and its peers are not funding this exclusively with cash flow. They are issuing debt, diluting equity, and in some cases forming complex partnerships that obscure true exposure. Microsoft's long-term debt has grown substantially. The company is still cash flow positive overall, but the AI segment itself is almost certainly cash flow negative when you account for the capital intensity. The bet is that future cash flows will dwarf current outlays. If that bet proves incorrect, or even if it proves correct but takes longer than the market will tolerate, the repricing will be savage. We saw a preview in after-hours trading. A 7% drop on strong earnings is the market saying, "We no longer believe the narrative justifies the valuation." Most people miss this turning point because they focus on the wrong indicators. They see revenue growth and assume health. They see technological progress and assume commercial success. But systemic breaks don't happen because technology fails. They happen because financial structures built on assumptions of perpetual growth encounter reality. The assumption underpinning $75 billion in annual AI spending is that demand will grow fast enough and sustain high enough margins to justify the outlay. If demand grows but margins compress, the model fails. If demand grows but takes 5 years instead of 3 to reach critical scale, the model fails. If a competitor launches a breakthrough that makes current infrastructure obsolete, the model fails. There are more ways for this to break than to succeed, and the market is beginning to price that in. Let me address the immediate counterargument because it's the one you'll hear repeatedly from company executives and sell-side analysts. They'll say, AI is different. This is a general-purpose technology. Demand is just beginning. Every industry will be transformed. The total addressable market is in the trillions. All of that is true. AI is transformational. The long-term demand is real. But that doesn't mean the current pace and structure of investment is rational or sustainable. The railroads transformed America. The internet transformed the world. Both were real, both were important, and both destroyed the initial cohort of investors who overbuilt capacity ahead of demand. The question is not whether AI will matter. The question is whether the companies spending $75 billion a year can extract sufficient value from that spend before the competitive dynamics and capital costs crush their returns. Here's what makes this cycle accelerate faster than previous ones. The speed of information flow and capital mobility is exponentially higher than in the railroad era or even the dot-com bubble. Sentiment can shift in hours. A single earnings report can erase 150 billion in value overnight. High-frequency trading algorithms, momentum strategies, and leveraged positions amplify moves in both directions. When a stock like Microsoft, which is held in virtually every major index fund, pension fund, and institutional portfolio, drops 7%, it triggers automatic selling, margin calls, and risk reduction across the system. This creates reflexivity. The price drop validates the concern, which causes more selling, which validates further concern. Once this loop begins, it's very difficult to stop until a new equilibrium is reached, often far below where rational analysis would suggest. We're also seeing this play out in the broader AI supply chain. NVIDIA's stock, after a meteoric rise, has shown increasing volatility. Any sign that demand growth is slowing or that customers are delaying orders sends the stock down sharply. The companies buying NVIDIA chips are now facing investor pressure to justify the spend. If they can't show near-term returns, they'll slow purchases. If they slow purchases, NVIDIA's growth decelerates. If NVIDIA's growth decelerates, the entire AI infrastructure narrative gets repriced. This isn't a linear process. It's a network of interdependencies where stress in one node propagates instantly across the system. The human impact of this is already becoming visible, though it's early. Technology companies that expanded headcount aggressively in 2020 and 2021 have been cutting jobs for the past 18 months. Microsoft itself has conducted multiple rounds of layoffs. The justification is always efficiency and reallocation toward AI. But the subtext is clear. The cost structure built during the zero-rate era is incompatible with current financial reality. As AI investments fail to generate expected returns, the pressure to cut costs elsewhere intensifies. Engineers, salespeople, support staff, these are real people whose livelihoods depend on the continued financial health of these companies. When the market reprices a stock by $150 billion in a few hours, that's not abstract. It represents future hiring freezes, project cancellations, reduced bonuses, deferred promotions, and eventually layoffs. Beyond the direct employees, consider the extended ecosystem: data center construction, semiconductor fabrication, energy infrastructure, cooling systems, networking equipment, real estate and tech hubs. All of this has been booming on the assumption that AI spending will continue at current or accelerating rates. If that assumption breaks, the ripple effects will be severe. Construction firms will see projects canceled. Semiconductor suppliers will face order reductions. Real estate in markets like Seattle, Silicon Valley, and Austin will soften as hiring slows. Local governments that budgeted based on property tax and business tax revenues from tech expansion will face shortfalls. This is how localized financial stress becomes systemic. There's also a critical international dimension that's often overlooked. Much of the AI infrastructure build-out is concentrated in the United States, but the supply chains are global. Taiwan Semiconductor Manufacturing Company, TSMC, produces the most advanced chips. Rare earth materials for electronics come from China and other countries. Energy demands for data centers are straining grids in the US and Europe. If geopolitical tensions disrupt any part of this chain, or if energy costs spike due to supply constraints or policy changes, the economics of AI infrastructure deteriorate further. We're not operating in a stable global environment. We're in a period of increasing fragmentation, trade tensions, and resource competition. Any shock to the system, whether it's a semiconductor shortage, an energy crisis, or a trade war, would compound the financial stress already building in the AI sector. What you're also seeing, and this is crucial, is the beginning of a credibility crisis. For the past 2 years, technology executives have been telling investors and the public that AI will generate unprecedented value. They've used this narrative to justify valuations, raise capital, and defend spending. But narrative has a shelf life. At some point, The market demands proof. Microsoft's earnings report was strong, but it wasn't strong enough to justify the trajectory investors had priced in. That gap between expectation and reality is where wealth destruction happens. It doesn't require a recession. It doesn't require an external shock. It simply requires that the story people believed stops being believable. Once confidence erodes, it accelerates. Investors who were willing to hold through volatility start selling. Analysts who were bullish downgrade ratings. Debt that was easy to refinance becomes expensive. The cycle feeds on itself. Let's talk about what happens next, because this is where the structural analysis becomes forward-looking without pretending to prophesy exact dates. We're entering a phase where the scrutiny on AI return on investment will intensify across the sector. Every quarterly earnings call will be dissected for signs of monetization. Every capital expenditure announcement will be questioned. Companies that can't demonstrate clear paths to profitability in their AI segments will be punished. This will force difficult decisions. Do they continue spending and risk further market disfavor? Do they cut spending and risk falling behind competitors? Either choice carries risk. This is the trap of coordination failure. If everyone cuts spending, the sector stabilizes, but growth expectations collapse. If some cut and others don't, those who cut lose competitive position, and those who don't risk financial distress. There's no clean exit. History suggests that in these situations, the companies with the strongest balance sheets and most diversified revenue streams survive and eventually thrive. Microsoft, despite the current pressure, is still immensely profitable in its legacy businesses: Windows, Office, Xbox, LinkedIn. It can sustain AI losses longer than startups or less diversified firms. But survival doesn't mean shareholders avoid pain. Even strong companies can see their valuations cut in half or more if expectations reset. And the broader market ecosystem, the startups, the venture capital funds, the specialized AI firms, many of these will not survive a prolonged period of tight capital and weak returns. The dot-com crash didn't kill the internet. It killed thousands of internet companies and wiped out investors who funded them. We're also likely to see increased regulatory scrutiny. When capital is being deployed at this scale and public markets are involved, governments pay attention. If AI investments fail to deliver promised benefits, or if they create systemic risks like energy shortages or labor displacement without offsetting gains, political pressure will build. That could mean anything from antitrust actions to restrictions on data center construction to mandates on energy use. Regulatory intervention rarely arrives at convenient times for industry. It tends to arrive when financial stress is already building, adding another layer of uncertainty and cost. The most important thing to understand about this entire dynamic is that it doesn't require malfeasance or bad intentions. Microsoft's leadership genuinely believes AI will transform computing. They're probably right in the long term, but markets don't operate on long-term faith when short-term cash flows don't support valuations. The mathematics of return on capital are unforgiving. If you spend 75 billion and generate 10 billion in incremental revenue, your return is negative. If your competitors are doing the same, creating overcapacity, your pricing power erodes, making future returns even harder to achieve. This is a structural trap, not a moral failing. The system itself incentivizes behavior that collectively becomes destructive. At this stage of the cycle, the signals are unmistakable for those watching the right indicators. Volatility is increasing, investor patience is shortening, the gap between narrative and financial reality is widening. Companies are being forced to defend spending that was previously accepted on faith. These are the conditions that precede repricing events, not corrections, not healthy pullbacks. Deep structural repricing that reflects a fundamental reassessment of value. When that happens across a sector as large and interconnected as technology, the wealth destruction is measured not in billions, but in trillions. The 7% drop in Microsoft, representing 150 billion in market cap, is a tremor. If the underlying dynamics don't change, the earthquake follows. We've been here before. The pattern is consistent. Transformative technology emerges, capital floods in, capacity is overbuilt, returns disappoint, confidence breaks, prices collapse. The technology eventually succeeds, but on a slower timeline and with different winners than the initial investors expected. The wealth doesn't disappear in the sense of being destroyed physically, it's repriced. Assets that were valued at one level get revalued at another, often 50 or 70% lower. The people holding those assets, when the revaluation happens, bear the loss. This time, given the scale of investment, the concentration in a few mega cap stocks, the degree of leverage in the financial system, and the speed of information flow, the repricing will be faster and more severe than most are prepared for. The title of this analysis isn't hyperbole. It's a structural observation. We are watching the early stages of a wealth destruction event that has the potential to exceed previous cycles because the absolute scale of capital at risk is larger, the concentration is higher, and the leverage embedded in the system is more pervasive. Microsoft's 7% drop is one data point, but it's a data point that reveals the fragility beneath the surface. When the market no longer believes the story stops supporting the price. And when the price falls, the story becomes even harder to believe. This is how systems break, not all at once, not with a single catastrophic event, but through a cascade of smaller failures that reveal the structure was unsustainable from the start.